This video is going to teach you credit spreads. Credit spreads are very advantageous for a couple of reasons. First of all, they limit your risk. So no matter what happens in the marketplace, you have a defined amount of risk, number one. Number two, you can trade things that you wouldn't be able to afford in your regular account. Let me walk through some examples with you. I'm going to show you using the app, using my screen, and go through click by click. Now, before we jump right in, do me a favor and make sure you're subscribed to the channel because I'm putting up videos just like this every day, and it really helps you learn and create yourself income. The more subscribers we have, the more people just like you see this great content. So as we get started, before I show you the actual trade, I want to help you understand what a credit spread is and how you can trade a credit spread. Now, a credit spread, you can trade it one of a couple of different ways. You can trade a put credit spread in which you're selling one put and you're buying a put underneath. You can also do it on a call basis. So you can trade a call credit spread in which you're selling a call and then you're buying a strike price over the one that you sold. Don't worry, we're going to walk through these step by step. An iron condor, that's just a combination of the two, a put credit spread plus a call credit spread. We're going to walk through each of these scenarios here in this video. Let's start with a put credit spread. First, we're going to choose the ticker. I'm just going to use Tesla as an example because Tesla is an expensive stock and you might not be able to afford that in your account. Now let's start with a put credit spread and let's use Tesla as an example. We're going to type the ticker in here and fetch the data. And then we're going to choose the expiration date. So just like when we sell a regular put, we choose what date we want the contract to expire. So Tesla has 3 days a week, Monday, Wednesday, Friday. Let's just use a week away, which would be August 19th. Now we get to choose which strike price we want to sell. And let me walk you through that. We're going to open this box here, and this is where we choose the strike price. Now we can see the delta. It's kind of like this sort of triangle-y looking icon. And the delta is like the cheat sheet way that tells us what the statistical likelihood is that the stock is going to drop below that price before the contract expires. So it helps us make educated choices. The further we go from where the stock is trading, the lower the price is. Now let's just use like an approximate 20 delta initially. So let's assume that we're going to sell the 315 put. Now Tesla right now is trading at 326, almost 327 per share, as we can see here. So this is a bit far away. So first we choose the short strike. That's the strike that we're going to sell, a $315 put. Next, we choose how wide we want to be. And here's what that means. If we sell a 315 put and we want to risk, let's say $500 on the trade, we would sell a 315 put and buy a 310 put. And we see that number here. And if we calculate everything, we get all the data in a table form. Now, it does look a little confusing initially, so I'm going to walk through all of this step by step, and it's not going to be hard to understand, I promise you. Just stay with me. Here's what you need to know. The width is how much risk you're taking. So you can either risk $500 on the trade, or if you wanted to be more conservative, you can risk $250 on the trade. You see, when I move the slider over, that means I'm selling the 315 put and I'm buying the 312.50 put. So that difference becomes kind of like the buffer that you have. And that's your maximum risk on the trade. Now, credit spreads are a little confusing again because there's a lot of moving parts. So let me go through what the most important things are. When you're selling a contract, typically you're going to sell at the bid price because there's already traders lined up to pay that price as a buyer. And when you're buying a contract, you're actually going to buy at the ask price. So the most conservative price that you would be able to get filled on if you took this trade here, you would be selling the short put at the bid and buying the long put at the ask. Now, don't worry if this sounds confusing. I'm just going to spell out all of the pieces and then we're going to walk through it together. We're holding this trade for about 7 days. The most important thing is the total risk that you have is $250 because that's the spread between the contract that you're selling and the contract that you're buying. You see how you're selling the 315 and you're buying the 312.50? So that's your $250 risk. This contract is paying a credit of 37, meaning $37 gets dropped into your account right when you make the trade. And because you're risking 250 but you're automatically making 37, the most that you can lose on this trade would be your maximum risk. And don't worry because the software tells you all the data. So in this scenario, the most that you can lose is $213. When you sell a put credit spread, as long as the price stays above this $315, you'll be able to make the entire credit, this $37 here. Worst case scenario, if the stock drops below $312.50, you would lose $213. That's probably the most important thing that you want to understand. And then the next most important thing you want to understand is that the break even, the price at which the stock would have to go in order for you to not win, not lose, is $314 and change, 63 cents to be precise. And with the amazing paper trading module inside this app, you can actually practice all of these trades without using your own real money. So you can set up all these trades and send it right to your paper trader account by clicking this button here. Okay, so that was a put credit spread. Let's go over a call credit spread. So a call credit spread is where you sell a call and then you buy a call over the price that you sell. And let's go through an example because that's the easiest way for you to understand. So just like previously with the put credit spread, we're going to choose the short strike. So that's the strike price that you want to sell that call. Now right now, Tesla is trading at 320, almost 327 per share. So let's go kind of far away from where the contract is trading. Let's look at a 20 delta. So that is a 342.50, right? So Tesla is trading at 327 and we're going to sell a 342.50 and then we're going to buy a 345 over the one that we're selling. And that's what gives us that protection. So no matter what happens, our risk is right here, this width of $2.50. And because each contract is 100 shares, that means our risk is $250. So that's the most that we can lose. But this contract is trading for a net credit of $36. So we take the trade, we get $36 dropped into our brokerage account, and then the worst case scenario, if Tesla closes above $345, our maximum risk on this trade would be $214. And we can also again see the break-even period here of 342.86. Again, if this is confusing, just practice it. The easiest way to learn a new concept is not by reading about it, not by watching a video or listening to a speaker present, but by actually doing it yourself. And you can literally do that with pretend money in the paper trading application inside this app. Now, before we end the video, I want to also talk about the Iron Condor because there's 3 different types of credit spreads that we can sell. A put credit spread, a call credit spread, and the third kind is an Iron Condor, which is a mixture of both the put and the call. And the advantage of that is because we don't know where the stock is going to go, we sell a put, we buy a put underneath, and at the same time we sell a call and we buy a call over that. So as long as the price stays within that band, we can keep the entire credit receipt. Let's walk through an example. Now, just like before, we're going to choose the strike prices. So let's just stick with a 20 delta. Now, we won't see an exact 20 delta, but we're going to find the closest match. So on the short strike, we're going to use a 21 delta, which is a $315 put. Then on the short strike for the call side, we're also going to look for a 20 delta. So that's going to be a 342.50. So we're going to choose both strike prices first, and we're just going to use the same delta. That's number 1. Number 2 is we're going to choose the width. This is how much risk we want to take on the trade. Now, I'm a big believer that it's generally better to be more conservative. So instead of risking $500, let's only risk $250. So I'm going to move the slider down here, and then I'm going to calculate the trade. And the app is going to do all the work for us. It pulls up all the mid prices, but if I wanted to be super conservative, I would be selling at the bid and buying at the ask. So this would be the most conservative fill, and it tells me that my worst case scenario would be a credit of $66. Let's walk through this together. Now Tesla right now is at 326.89. We can see the price here. And this iron condor would be selling a 315 put, but then also at the same time buying a 312.50 put. And at the same time selling a 342.50 call and buying a 345 call. So you're selling a put underneath where the stock is trading, and then you're buying another one as protection. So as long as the stock stays in between $315 and $342.50, you'll be able to earn the entire credit of $66. And the worst case scenario is your maximum risk in this trade example would be $184. And for those of you who want to understand where that number comes from, the most you can lose is $250 because we have a width of $2.50, but then we're also receiving a credit of $66. So our net maximum risk, worst case scenario, is $184. Now it is important that you close the position manually before the contract expires. I talk about that in other videos. This video here is just showing you exactly how to set up the trade. And then just like the other trade ideas, a put credit spread and a call credit spread, you can actually just push this right to your paper trader account and practice with money that is not even yours. So you can practice and see exactly how the trades end up over time. There's no better way to learn than by actually doing it yourself. And when you don't use real money, that is like the icing on the cake.